Good morning. Thanks for tuning in to today's webinar, Year-End Accounting and Disclosure Update. My name is Diane, and I will be your moderator. Before we get started with our presenters, I'd like to review a few housekeeping items. One, starting with your webinar pane. If you'd like to adjust your audio, just click the orange arrow to expand your pane, and we also have a question feature there as well, so you can enter a question for our presenters, and we'll get to as many of those at the end of the presentation. For the best audio settings, if you're tuning in on your telephone, just click the telephone mode, or if you're listening through your computer, click mic and speaker mode. All right, so if you're on today's webinar to get California CE, there's a few things that you need to be aware of. You need to use your personal computer, no PDAs, and log in with your own unique URL. Be logged into our software for at least 50 consecutive minutes within the scheduled time frame of the webinar, and then respond to at least 75% of the polling questions. And then at the end, just complete the evaluation survey. All right, so for our learning objectives today, during the webinar, participants will analyze the scope disclosure rules for offsetting assets and liabilities, review the reporting requirements for reclassifying items out of comprehensive income, and break down the presentation rules for liquidation basis of accounting, and discuss the deferral of certain disclosures of non-public employee benefit plans. And finally, we'll be discussing the status of the private company GAAP. All right, I'd like to welcome our first presenter today, Matthew Peralt, SEC and Technology Practice Leader at Armanino. Matt has over 20 years of experience, including supporting more than 50 technology sector transactions. He has participated in numerous IPOs, mergers and acquisitions, private placement, and LBOs, both in industry and as an auditor. Matt's prior experience includes serving in the technology audit practice at Ernst & Young, also in private industry as Controller and VP of Finance at HMT Technology, ThermaWave, and StorageWay. He is a recognized subject matter expert and frequently consults in the area of revenue recognition, business combinations, and equity accounting. Matt, it's great to have you here with us today.
Thanks, Diane.
And for our second speaker, I'd like to introduce you to Michael Bolton. Mike is a manager in Armanino's audit practice. He graduated from Cal Poly San Luis Obispo. He is a certified public accountant and certified fraud examiner who provides audit services for both public and privately held companies. Additionally, Mike performs fraud investigations for the nonprofit, manufacturing, and technology industries. Mike, welcome.
Thank you.
All right, so Matt, I'll turn it over to you.
Thanks, Diane. So, today we're going to be taking a look at what do we got listed here? 9 different updates that happened during the course of the year issued by the Financial Accounting Standards Board. We elected to omit some of the more esoteric pronouncements that came out during the year, or if they were just simple updates or technical corrections to previously issued pronouncements. So the highlights of today that we're going to run through are the presentation for income taxes, specifically unrecognized tax benefits, a change on derivatives and hedging, presentation of financial statements, taking a look at foreign currency issues, comprehensive income, balance sheet offsetting, fair value measurements, and finally what the FASB is looking at down the road. All right, so the first item we're going to start off with today is presentation of unrecognized tax benefits, and that's found in the code under ASU 2013-11. For those of you that aren't familiar with how the coding works, every time the FASB has an update, they first issue it under the Accounting Standards Update, and that effectively isolates the changes that are happening within the code. But effectively the ASU goes away, and then the changes that have been made in the code are sort of the authoritative guidance from there forward. So, this piece of guidance really is a clarification on how companies should be presenting unrecognized tax benefits. And for those of you that are not deeply involved in accounting for income taxes, an unrecognized tax benefit is effectively one of two things. It's when you've taken a filing position in a tax return and then in subsequent years you take a look at that tax return and you say, oh, darn, we made a mistake. But you continue to record those, or you continue to not show a liability for those amounts. And secondly is basically it's a filing position that you know you should not take in a tax return because you believe that it would be disallowed. And examples of those certainly are net operating loss carryforwards. Maybe you've gone out and acquired a company, or maybe you, the company, have had changes in control that limit those net operating losses, but you haven't done the full study to see what amount is available to you. So you've intentionally taken a reduction in those. And I guess there had been significant diversity in practice around how folks were accounting for these. Some people were reviewing these unrecognized tax benefits as an allowance. So they were reducing the assets. Or so an example there is just an NOL carry forward or a tax credit. If you did an R&D tax credit study, but you thought there would be some amount disallowed, so you haven't taken that as an asset on your balance sheet. So you just have reduced it as an asset. Other folks elected to treat it differently and were recording effectively a FIN 48 liability for all of these amounts. So if we want to jump to the next slide.
All right, so we have our first polling question. Okay, so our first polling question today is, does your company have unrecognized tax benefits? Yes, no, or not sure? All right, so we'll have a total of 5 polling questions, and you'll need to be logged on for at least 75% of those and be logged into our software for at least 50 consecutive minutes. Okay, so we're going to close the polls in 5, 4, 3, 2, 1. All right, so Matt?
So it looks like at least a third of the audience is not sure about unrecognized tax benefits. And again, the most common description I've heard for these things is just FIN 48 reserves or FIN 48 liabilities, again, where your company has taken a filing position on a tax return that it believes is not more likely than not to stand up to IRS or other taxing authority scrutiny. And so you've taken a reserve against that amount that you have already shown as a deduction on your income taxes. So, you know, that's pretty much the simplest explanation I can give for it. So what does this rule change? Well, the rule really doesn't change anything in the way that we as a firm have been recognizing and consulting with companies. And effectively we've said if you have an asset on your balance sheet that you are allowing for, then it should be treated, any reserve you take against that should be treated as a reduction of the asset account. So that makes sense. Other folks that had possibly been putting all of their FIN 48 liabilities as just one amount on the balance sheet as a liability, this disclosure rule now basically clarifies and says, no, you should be taking that as a reduction of the related asset. There are a couple of small exclusions, basically that's saying that if you're expecting tax law to change in the future, and this is why you're creating an allowance, but it's currently is a deductible item, then you should be treating that as a liability. And effectively, you know, there are no new disclosure requirements, so no updates to the footnotes that need to happen as a result of this change. It's really just balance sheet presentation. So again, our recommendation here is just work with your folks that do the income tax accounting as well as your audit firm and make sure that you're treating all these amounts as reductions to the deferred tax assets. And the effective dates are for public companies. You want to start doing this for the years beginning and interim periods beginning after Q4 of this year, and then for non-public companies with a year end anytime after December 15th. So 2015, and certainly early adoption is permitted, and it should be applied only prospectively, so no need to go back and restate your balance sheet if you've not been following these rules.
Okay, next up we have an update that has to do with some hedging activity and some clarification of the rules surrounding some of the benchmark interest rates that can be used for hedging. This is a result of ASU 2013-10. So some background on this rule. First of all, it's really only applicable to entities that are hedging against interest rate risk. So FASB's, their Topic 815 provides guidance on what risks are allowed to be hedged upon, and one of those is interest rate risk. Now, just to provide some background or a refresher for you, interest rate risk is the risk that a change in a value that you're hedging due to a designated benchmark interest rate. Now, prior to this rule being issued, FASB only allowed the use of two specific benchmark interest rates for the purpose of that hedging activity, one being direct treasury obligations of U.S. government and the other the LIBOR rate. Now, following the great financial crisis of 2008, the demand for hedging against the Fed funds rate skyrocketed and increased significantly, so FASB considered that and decided to see if that needed to be incorporated into this rule. Now, if you aren't familiar with the Fed funds rate, that's the interest rate that banks charge each other to trade balances back and forth that are held at the Federal Reserve. Now, this is typically done overnight, which is where this overnight term comes into play on this interest rate. Now, the weighted average of this rate that's across all banks on any given day is known as the daily Fed funds effective rate. And then the Fed funds effective swap rate, also known as the overnight index swap rate, or OIS for short, is the fixed rate that is swapped against the floating overnight rate. So in essence, you're swapping this fixed OIS rate for a variable daily effective rate. Now, the purpose of this rule is really to include a third benchmark adding to those two I mentioned before, and that third benchmark rate that's being added is this OIS, or the Fed funds effective swap rate. Now, originally FASB was somewhat against adding a third benchmark rate here because they thought that would make financial statements even more convoluted and difficult to understand for users than they already are. But ultimately, after some pushback from stakeholders and the individuals that are performing these benchmark activities, they thought it would be valuable to include this third benchmark rate, and ultimately that's providing risk managers a more comprehensive spectrum of interest rates that they're able to utilize and benchmark against in their hedging activities. So the effective date of this rule is July 17th, 2013, which is the date that the rule was issued, so it's basically effective immediately. It's only effective for qualified new or redesignated hedging relationships that have been entered into on or after that July 17th, 2013 date. So you can't go back and apply this on a retrospective basis. You can only apply it prospectively moving forward on new hedging activities.
All right, so we have our second polling question, and the question is, does your company have derivative or hedge accounting? Does your company have derivative or hedge accounting? Answer yes, no, or not sure. All right, we have got quite a few votes coming in right now, so we'll give you just a few more seconds. And we'll close the polls in 5, 4, 3, 2, 1.
So as the results come up here, you'll see a little bit as I anticipated, a large majority of you do not have derivative or hedge accounting, at least applicable to what we talked about now. 82% of you are not in this space. You may be in some derivative accounting that isn't quite applicable to these interest rate risks, but that's consistent with what we thought, so that's why we kind of kept it quick on this topic.
All right, so now we're going to cover ASU 2013-07, which is liquidation basis of accounting, and I hope for the majority of folks on the line you're not into the liquidation basis of accounting. Again, so we'll keep this fairly high level. And for those of you that aren't familiar with it, liquidation basically is the process when a company has decided that they're going to end the company at some point in time, and they're going to liquidate. They're going to sell everything, settle up all the assets and liabilities, and then give a distribution to the shareholders. And there are existing rules that basically say that once you've made the decision to liquidate the company, you have to move to a different basis of accounting other than your standard sort of going concern accounting. And really the reason that is to give the investors, who are the primary users of the financial statements in the company, some expectation around how much cash they should ultimately expect to receive when this company settles up. And the reason for this update is that there is really a lack of guidance on this topic as to when you should apply the liquidation basis of accounting, and then specifically the procedures that you would go through to evaluate your assets and liabilities. And I know this from a couple of years ago when one of my clients was going through liquidation basis. We did sort of a global search, not just in the accounting research tools that we have, but also for public companies that had done some liquidation basis of accounting. And there really is sort of an absence not only of guidance, but an absence of examples out there for public companies that have gone through this liquidation basis of accounting. So some of the highlights of the rule is that you should be presenting the financial statements on a liquidation basis only when it is determined to be imminent. Now the rule goes on to define imminent as the likelihood is remote that the organization is going to return from its liquidation, and further that there is a plan of liquidation that's been approved by people who have the authority to approve that plan, and effectively there's a minimal likelihood that that plan could be subsequently reversed. And additionally, whenever there's a liquidation that would be mandatory, let's say a bankruptcy court came in and mandated it, that would also meet the definition of imminent, and therefore liquidation should be the proper basis to use. And there's really some enhanced disclosure requirements that are intended to give the users of the financial statements more information about the liquidation, and we'll run through some of these here. That effectively what you do is you're now sort of accelerating the process under which you would normally be producing a P&L and an income statement, and effectively you are accruing all costs that you expect to incur through the expected remaining life of that company. So if you say it's going to take us 2.5 years to sell all the assets of that company, pay off all the severance and employees, and wind down the business, sell the final building, then effectively you take a look at all of those costs that you're expected to incur, including legal fees, accounting fees. If the bankruptcy authority or the governing body is requiring you to get an audit, well, then you need to accrue for those audit costs. What does it take to prepare tax returns? You need to, basically factor in every single expense that you expect through the entire period of liquidation. And then all of the values on your balance sheet should be effectively the cash proceeds that you expect to either get for the assets or the cash that you expect to expend. So there is no notion of present valuing those amounts. You basically just say, here's the expected cash at the end of the day. And then also note that there are certain companies that are excluded from this, one of those being any company that's an investment company as defined under the 1940 Act. And so for this, again, any companies that have a calendar year end that is ending on or after December 15th, 2013, and early adoption is permitted, and it's only the only requirement of this rule is that it be applied prospectively. So again, if a company is going through liquidation and they haven't met all of the requirements of this rule, you would only need to do that beginning after this current year end.
And Matt, I was just going to add or try to give our listeners some clarification on this. If you have any input too, I know us as accountants, especially some of our clients, like to put a percentage probability of something happening, when that might trigger, a recognition of some type of disclosure or accounting treatment. This being the imminent terminology and the remote likelihood of basically recovering or not becoming a liquidated entity, you can't really put a percentage probability of that happening, right?
Yeah, I would say imminent was probably 99% plus likelihood that this liquidation is going to happen. So the normal rule for accruing liabilities is just more likely than not, so which is typically a 50% threshold, so definitely you want to be well north of that 50% measurement point.
Okay, next up we have some foreign currency discussions. This is a result of ASU 2013-05, and it really has to do with foreign subsidiaries and your cumulative translation adjustment, or CTA for short, and how you account for that and de-recognize it when a foreign subsidiary no longer exists. So kind of some quick background. If you're a company that does have foreign activity and foreign subsidiaries, you're probably quite familiar with CTA and how that comes about. You may or may not have ever dissolved a foreign subsidiary and had to deal with releasing any CTA out of equity, but it is becoming a little bit more common, as we're seeing with some of our clients, as they try to cut costs in different ways and get a little bit creative. And sometimes they decide to close a foreign subsidiary for different reasons, and they may or may not be aware that that can trigger this kind of non-cash either income pickup or expense charge on their income statement by de-recognizing the accumulated translation adjustment from that specific foreign entity that they are dissolving. So really just some background on how this is coming about and what it means. It's really a clarification update. There's been some very wide diversity in how this rule has been interpreted and applied in the past, and so this rule is meant to really bring this together and get everyone consistent moving forward. Just to give you some background on why there's been diversity in practice, there's really two accounting areas or rule areas that have been used for this type of transaction. There's foreign currency accounting, which is under topic 830, and then there's the consolidation accounting guidance under topic 810. Now, the foreign currency accounting previously required releasing this accumulated CTA balance only when a parent sold an investment in a foreign entity, and that sale constituted a complete or substantially complete liquidation of that entity. Now, on the other hand, the consolidation accounting previously required the release of CTA only when that parent no longer held a controlling financial interest in a subsidiary, and it defined losing a control or controlling financial interest was defined by either a sale, the end of a contractual agreement, which might be when you have contractual agreements with subsidiaries for a specific time period, and if that ends, they're no longer a consolidated entity. Or the third definition of losing control was if the subsidiary issued additional stock and effectively diluted out the controlling interest from that parent company. So that's the diversity in practice from those two different areas. There's also diversity in practice surrounding how this relates to step acquisitions. Now, step acquisition, if you're not familiar, is basically increasing your ownership in an entity from an equity method investment, so partial ownership percentage, up to a fully controlling interest that then is consolidated in with the parent company. Now, some companies with step acquisitions considered that type of transaction, that step acquisition, as a two-step process, first disposing of that equity method investment in the company, and then turning around and acquiring controlling interest in the company. And those that viewed it as a two-step process would release CTA from that disposed equity method investment, since that was how they viewed it. Now, on the other hand, other companies viewed step acquisitions as one simultaneous continuous transaction, and for that reason, they did not release any CTA from that foreign entity. So that's kind of the background on this rule and why FASB realized there's some diversity in practice and maybe there needs to be a change to get people consistent and reporting consistently. So some of the highlights on how this rule has been changed and the way it brought consistency moving forward. The new rule basically brings all the guidance more in line with the former foreign currency accounting that I mentioned, which basically requires releasing CTA upon the sale or complete liquidation of an entity. So kind of what they ended up doing is the consolidation part of FASB guidance was amended, and now it refers over to the foreign currency topic guidance, and it's the consolidation guidance now also specifically states that CTA should be released when deconsolidating a foreign entity. just to give you some context, before the consolidation, derecognition of a consolidated entity guidance was pretty vague. It just said derecognize all related assets and liabilities. It didn't give much color to derecognizing foreign currency matters, but now it's a little bit more specific. On the other hand, the foreign currency side of the rules has been amended to specifically define what a sale means, and part of that definition includes losing a controlling financial interest as defined in Topic 810, the consolidation guidance. So those two topics were amended to pretty much refer back and forth to one another and stop individuals from trying to interpret one versus the other. It really makes them more consistent. So in effect, they kind of just meshed the two former rules to be more consistent with each other. Now, the rules that were updated for step acquisition situations, they amended the rules to require releasing CTA during a step acquisition transaction. So they decided to take on that two-step approach that I talked about. You're effectively disposing of equity method investment, releasing the CTA that's been accumulated from that entity that you've invested in, and then you're acquiring control of, in effect, a new company, and you start fresh on your cumulative translation adjustment. Also something to note, sale of equity method investments. So if you have this partial ownership in a foreign entity and you sell it off, you would recognize a pro rata portion of CTA that's been accumulated. That was still in effect before, and it's still in effect now in the new amendment as well. There's also a pretty helpful flow chart that's available that we'll show just very briefly on the next slide. By no means are we going to try to go through this in detail with you because it is small and we had to squeeze it in here on the screen, but mainly just wanted to make sure that you're aware that it's out there. It's not as daunting as maybe you would think. Just a couple boxes to go through, and it'll help you make these decisions on whether or not to release CTA and kind of take that income statement charge or pickup depending on the balance of that CTA and the facts and circumstances of the situation.
And Mike, when one of the things I think we find pretty frequently is that when companies are in the process of winding down foreign operations, it takes a long time to not necessarily dispose of all the employees, but to get some countries are not very cooperative, and they almost want a bribe payment in order to legally close down the entity and get confirmation from that country that there are no further obligations of that entity, and just getting that confirming paperwork back from the government can be sometimes a very lengthy several-year exercise. So, Mike, what would your view be on when is liquidation substantially complete?
Yeah, I mean, I think like any accounting rules, unfortunately, there's some judgment that gets put into play. So that would be, management can evaluate, are there operations, have they ceased, is there really just a matter of paperwork that needs to be filed, and has that constituted a substantial liquidation of the entity? Then they can go ahead and take that derecognition of CTA. If there's doubt about kind of how long that may occur, the conservative method may be to kind of defer recognizing that derecognition of the CTA until it's literally closed, so to speak. So to give you an idea of when this is effective, for public companies, it's effective for fiscal years beginning on or after soon, December 15th, 2013. For non-public or private companies, they have a 1-year waiting period. FASB thought that private companies could use a little extra time to get familiar with the situation. I think they viewed maybe more public companies are applicable to this rule, and so private companies have a little more time to get used to it, get to see how public companies are adopting it and how they're disclosing it, and then it's applicable to them for fiscal years beginning on or after December 15th, 2014. Early adoption is permitted for both public and private companies. It does need to be applied prospectively. They were very explicit in stating that you cannot adjust prior periods for this, so you can't go back and say that, I should have taken that $1 million CTA income pickup last year because that's when we thought it was substantially liquidated. You can only, once adopted, apply it prospectively moving forward.
All right, and for our third polling question, the question is, has your company de-recognized CTA from a foreign subsidiary? Answer, yes, no, yes, but I don't know it was accounted for correctly, or D, we don't have foreign subsidiaries. All right, so we have a few more seconds. If you have a question for either Matt or Mike, please just click the orange arrow on your webinar pane to expand that and type your question in, and we'll answer it at the end. All right, so we're going to close the polls here in 5, 4, 3, 2, 1.
So the results should be popping up here any minute for you on your screen, and you'll notice that 4% or very few of you have actually had this occur. And if you did, hopefully it was accounted for correctly, and the derecognition of that CTA was timely. 45% of you answered no, this has not occurred. You have not derecognized CTA from a foreign subsidiary, which is fine. Just be aware that this rule is out there and will be effective soon for you. And as I mentioned before, some companies are trying to look for creative ways on cutting costs, and so this is a byproduct of when that happens, when you deconsolidate a foreign subsidiary. Again, as I mentioned, this is effectively a non-cash income statement charge, so that'll how it'll be accounted for. And lastly, 49% of you don't have foreign subsidiaries, so luckily for you, you don't have to worry about this at all for now.
All right, so the next item we're going to talk about is comprehensive income. As you're aware, last year a new rule came out requiring the new statement of comprehensive income, where you effectively pulled it out of your statement of equity, either put it as its own standalone statement or put it at the bottom of your P&L and just sort of rolled forward net income to get to comprehensive income. So the rule here really doesn't change the presentation requirements on the face of your financial statements, but what it does is expands the disclosure requirements for items that have a significant impact on your P&L that were a result of reclassifying items out of other comprehensive income. It's interesting too, whenever you read through these new accounting pronouncements, the background and you know, they always come up with the reason for issuance, and I think it's pretty boilerplate. The reason for issuance is always to improve transparency. It's to offer the investors what most folks view as a better insight into the financial performance of the company, and oftentimes it's intended to introduce simplicity, but you know, I think there's argument as to whether or not that's always accomplished by the myriad of accounting rules. So let's jump to the next page. It is effective for public companies December 15th of 2012, and then for non-public companies it would be effective for this calendar year end, and it's to be applied prospectively. And really the most common area here that you would think about when an item is being reclassified out of other comprehensive income, at least the most common example that I've seen, is a realization of what had previously been an unrecognized gain on the company's available for sale securities. So let's say you had in the prior quarter $5 million of an unrecognized loss related to securities that you held as available for sale. And then the following quarter you roll forward and you sell those securities, so you're recognizing $4 million of that loss is effectively rolled out of OCI and then run through your P&L. And so what this disclosure rule really requires is now you put into the body of the footnotes another table that illustrates the P&L impact and specifically where in the P&L these items hit. So in that case, if you've rolled out, say, $4 million worth of loss on unrealized or $4 million in unrealized loss, and then you actually realized that loss, and then it flowed through your P&L as other expense, then in the footnotes you would be required to show the impact of that where it hit in the P&L. So you just illustrate in a table form $4 million worth of expense rolling out of OCI and $4 million worth of expense rolling into your P&L. And again, it's just intended to inform the users of the financial statements, because if you have big items that are in OCI and suddenly they disappear, the reader of the financial statements may be left wondering, where did that big unrealized amount show up? And some other common items that you're going to see in OCI are just currency translation adjustments. So if you've got big items that are denominated in foreign currency, and those items have not yet settled, and they settle in the following quarter, again, it just gives the users of the financial statements a bit more insight into where these items that were sitting on the balance sheet have now flown through. And the requirement extends not just to items that are flowing through the P&L, but if they have sort of a combined effect, and maybe partially that flowed through to the P&L, and another component of that flowed through to inventory, as an example, then you would want to illustrate that in the footnotes. So the rule here, and where it finally landed in the code, has some pretty good examples of mini tables that you throw into the footnotes. So it shows you how to sort of disaggregate what is combined often into your accumulated comprehensive income, and how to illustrate that in a simple table form in the back. Another option as well is to footnote the face of the P&L or the face of the OCI statement, and show where those items have flowed through, and the impact that they had for the disclosed period.
Matt, I was going to see if, to at least give our listeners an idea of what your thoughts are on, there's been a lot of changes to OCI presentation over the past 2 or 3 years. I think most notably, I think it was last year when they said the new rules on the face of the financial statements, whether it's a single continuous statement or 2 separate statements. With this change and any other down the road, does that change your opinion of the best way to present OCI? It's one single statement or the separate statement?
I think most public companies want to focus folks on net income, and they don't want to distract from the standard P&L that has been presented for years and years. So, I think they're presenting that other comprehensive income statement separately on a standalone basis. And I think, maybe down the road it will become more common to include that at the bottom of your P&L as an add-on. But again, I think, especially with the expectation that there's a lot of these items that the timing is really uncertain as to when they'll be recognized, and that's why many of these unrealized items are sitting on your balance sheet, and that's why it's probably more appropriate to put them in that separate standalone statement.
Okay, next up we have a new rule that has to do with presentation of your balance sheet. More specifically, it clarifies the scope of when you need to disclose additional information about offsetting assets and liabilities. This is a result of ASU 2013-01. So some background on this topic. If you aren't familiar, occasionally there's circumstances that allow you to offset an asset and a liability onto one line item on your balance sheet. And this, a former rule issued a few years ago required enhanced disclosures of when that happened and why you're doing it that way. And this particular ASU is clarifying the scope of that former rule, since there was some confusion on when it's applicable. Now, the reason for this rule clarification, FASB is basically responding to some big concerns that have been expressed by domestic stakeholders that this rule applies to, about how the previous standard was quite broad in its definition of financial instruments and those that require this new disclosure. The former rule that I mentioned that was issued was ASU 2011-11. It was issued in late 2011. And as I mentioned, it required enhanced disclosures in the company's financial statement footnotes for any offsetting arrangements. The goal there was to provide greater transparency to readers so that they're aware of what's being offset on the company's balance sheet. Unfortunately, that original rule was very broad in its definition of the arrangements that fall within its scope, and so that naturally caused some confusion amongst companies and as well as investors and readers of those financial statements. Now, after that former rule was finalized, companies, the reason for their confusion is because they began realizing that many of their kind of more simple general contracts have standard commercial provisions that allow them to net any receivables and payables they have with that vendor or customer in the event of a default. So that in effect equates to a master netting arrangement, which triggered them to increase disclosures in their footnotes resulting from that net down of the asset and liability. Implementing that new rule that came out for those disclosures naturally increased significantly the cost of compliance for those companies, and the perceived value to financial statement users and stakeholders was very low as a result of those added disclosures, and FASB felt that that was not the intended use of that rule that came out. What we mean by increased compliance costs for these companies is really what happened is they needed to then go in fear of being out of compliance and not disclosing what they should be disclosing. If effectively had to comb through all of their quote-unquote more simple contracts that they have to see if they qualified as a kind of pseudo master netting arrangement, then triggering these enhanced disclosures. So it just caused a lot of time and effort to comb through all their contracts to see if they need to disclose more in their footnotes. So this new rule update, in theory, should decrease compliance costs, time, and effort by companies as they won't need to be doing that anymore, and it should clarify the scope of what falls under this rule and allow them to quickly identify what they need to disclose and not disclose. The specific changes to this rule, the topic has been amended to specifically state that the topic's scope only applies to derivatives, repurchase agreements, and reverse purchase agreements, and finally securities borrowing or lending transactions that are either offset or are subject to an enforceable master netting arrangement. So if you have a contract that doesn't fall within one of those three topics, it's not applicable to this rule. You don't need to enhance disclosures related to that arrangement. The effective date of this rule update, it's effective as of the date of the previous rule that came out in late 2011. So as a result, the changes have to be applied retrospectively for all fiscal years beginning on or after this past January 1, 2013. So implementing this new rule, if you're a calendar year 2013 financial statements, you'll implement it retrospectively for all contracts that apply to this.
All right, so for our fourth polling question, the question is, the amendments from ASU 2013-01 require compliance from A, public and non-public entities, B, only public entities, C, only non-public entities, and D, interim reporting for public entities only.
That was a mouthful.
Yeah, so we'll give you just a few seconds to think about this and enter your answers in, and just wanted to let you know that the presentation slides and the audio will be available within 24 hours. Oh, within 3 hours of the presentation. You can load that and share that with your staff. There's a correction from the room. It's 3 days. My apologies, but you'll get an email from me, and that will include those links. Thanks. All right, so we're going to give you just a few more seconds, and we'll close the polls in 5, 4, 3, 2, 1. Thanks.
So the results should be showing up here on your screen. You'll see the majority, so about 3/4 of you technically answered correct. This is applicable to all entities, public and non-public. We didn't mention that as we went over the rule, but more of a de facto, since we didn't mention it was only applicable to certain entities, it's applicable to both. A few of you thought maybe it's only applicable to one or the other, but as I mentioned, it applies to all entities if you have anything that relates to balance sheet offsetting. Next up, this one's about fair value measurements. Again, this is some disclosure-related items. It's not a huge game changer in terms of any recognition or accounting. It's just about disclosures. This is a result of ASU 2013-09, and it actually only applies to employee benefit plan reporting, and it's really just defers some rules that were previously put out for disclosures of fair value measurements. So some background here. Again, I mentioned if you don't have an employee benefit plan or you don't meet the rules for audited financial statements, this doesn't necessarily apply to you at all. But if you do, even further, who it really only applies to is if you're an employee benefit plan that has plan assets invested in your own plan sponsor, which is the company that's sponsoring the plan, if you have plan assets invested in that plan sponsor's non-public stock. It's also only applicable to non-public employee benefit plans. If you aren't aware, certain employee benefit plans are considered public and file SEC Form 11Ks. That's when you have plan assets in your own plan sponsor's publicly traded stock and there's employee contributions to the plan. But that is not applicable here. This is only for non-public or private employee benefit plans. Some background here. This is a clarification rule that I mentioned as a result of a previous rule that was issued, ASU 2011-04, was put out in May 2011, and what it required was enhanced quantitative disclosures about fair value methods used to value level 3 plan assets held in the plan sponsor's own non-public stock. What I mean by that is basically your financial statement footnotes has some tabular disclosures about how you value your plan assets, and if you had plan assets in your own company's non-public stock, obviously that takes some interpretation or unique valuation methods to determine what those assets are worth, because it's not a publicly traded stock. And so there was requirement to enhance your disclosures of how you determine the value of that non-public stock plan asset. Now, there was immediate kickback as a result of this rule because these private companies that had to enhance these disclosures felt that they were releasing proprietary information by virtue of their financial statements that are actually basically publicly announced. If you aren't familiar, all employee benefit plans that meet a certain requirement have to file their Form 5500, which is basically their tax return, and attach to them audited financial statements. Well, that package is posted on a public website that anybody can access. So these companies were quite concerned that those footnotes could be read by anybody, including competitors, who could find out information of how that plan sponsor company is doing by virtue of the disclosures that were in the plan, employee benefit plan footnote. So FASB felt that that was valid concern, and they felt that that was not the intended purpose by any means of that previous 2011 rule. It was not meant to make public or private companies more transparent in their disclosures to the public. It was really just meant to enhance disclosures of how they're valuing assets. So as a result, FASB has deferred indefinitely those quantitative disclosure requirements for these non-public employee benefit plans with assets in their own non-public stock. However, this deferral of disclosure requirements does not defer rules for plans that have assets in other non-public stocks. So if you're a plan that has assets in a different private company from your own, you still need to make those quantitative disclosures of how you valued those plan assets, but you can defer it for your own company's stock. This rule, as I mentioned, is deferring indefinitely those disclosures. It's effective immediately upon issuance so that the stakeholders and the companies that are applicable to this rule can adopt it immediately. And it's applicable to anyone that hasn't filed or issued their financial statements as of now. They can adopt this rule for their next financial statement issuance.
All right, so now we're going to jump into some private company GAAP exceptions. And I want to move to the next slide. There have been 2 exceptions that have been approved, and let me back up a little bit here and tell you that for those of you that aren't aware, back in May of 2012, so a little more than a year ago, the FASB established a separate entity called the Private Company Council. And the intent of the Private Company Council is basically to take a look at all of the existing FASB rules and guidance and say, does this guidance make sense for private companies, or should there be some different rule that applies to private companies? And the way that works is the Private Company Council goes off and examines these items, deliberates, and then they put a recommendation in front of the FASB. And then the FASB does 2 things with that. They can either they can either elect to ratify it or kick it back to the PCC and say, you know, that we don't think this is appropriate for private companies, But similarly, they can take a look at the proposed rule change and say, does this make sense for public companies, and would we consider changing or adopting this for all companies, regardless of public or private status? So that's the way the entity is intended to work. And so what really you're seeing here is this two new rules that have been put in front of the FASB for approval. This is the first time, if the FASB approves these, that you will see a divergence in the reporting requirements between public and private companies. And again, the intent here is just that the thought is that private companies don't have the same resources and they don't have the same users or readers of the financial statements, so they should have more simplified reporting rules. So the first two items that the PCC is throwing in front of the FASB for approval are simplified hedge accounting. And again, for those of you that do hedge accounting, you know there's not a small amount of work involved in designating those hedges, tracking those hedges, and then doing the footnote presentation for those hedges. And basically this first rule that they put in front of the FASB is intended to simplify hedge accounting for interest rate swaps. When you have a variable interest rate that's been swapped by virtue of a derivative instrument to a fixed rate payment, it's going to eliminate all of the hedge accounting requirement rules. And then the one that I'm finding interesting is the amortization of goodwill. For those of you that go back several years, you know that goodwill used to be amortized over a 15-year period for both public and private companies. That rule changed. Now goodwill is just looked at for impairment, and basically it sits there on your balance sheet forever unless it's impaired. The new rule, again here proposed for private companies, is now to amortize goodwill over a 10-year period, and you would just look at it once a year for impairment. So interesting change in the rule, and makes me wonder if the FASB is going to consider the same approach for public companies. So the potential effective dates for these, again, assuming the FASB were to ratify these, then they would be effective for companies with a calendar year beginning on or after December 15 of next year. But the good thing is that early adoption would be permitted, so certainly where there's simplification of the rules, I think most private companies are going to elect to early adopt. The other items that we wanted to make you aware of that are on the FASB's plate is just leases that we have seen, and that's been ongoing since March 2009 when the FASB first put out a discussion paper. They got 800 comments on the proposed changes. Then in August 2010, based on the period of time that the FASB and the IASB took to digest those 800 comments, they came out with a proposed rule. And then they got so many comments even on the proposed new rule that they put out in August of 2010 that they again revised the standard to take into account the additional comments that they got. So they put out a revision in May of this year with all the comments due on the proposed revision in September of 2013. And we're sort of running out of time here to jump through all these items, but just wanted you to make aware that certainly it's going to have a significant impact. There are no more operating leases under this new rule. You can expect that both lessees and lessors are going to have to put an asset on their rule, and it's going to change the geography as well as the timing as to where leases are expensed through your P&L. And revenue recognition, again, we've done some webinars on these proposed standards in the past, and the FASB has come out with a new revenue model, again, taking into consideration the comments, but there's not significant changes to the initially proposed rule, but there are significant changes from the existing revenue rules, and certainly the elimination of all the complexity around software rev rec. So this is going to be a big change for companies that are currently under the software rev rec rules. But I think the good news is, if we jump to the next slide, that, I guess not the next slide, but the intended timing of these, the release of these rules is pretty far out, so you will have time to digest these, but they should, again, be on your radar screen.
All right, so this is our fifth and final polling question, and the question is, which is not one of the 6 factors that differentiate private and public companies? A, types and number of financial statement users, B, accounting resources, C, market volatility, and D, access to management. All right, if you've got any final questions you'd like to enter for our presenters, go ahead and type those, and we've got a few here. We'll get to those as soon as we finish this presentation. All right, we'll give you a few more seconds to enter your questions and answer feature. Oh, we're up to 79%, so we're getting close to being able to close now here in 5, 4, 3, 2, 1. Thank you.
All right, so the most common answer here was market volatility, and that is the correct answer. That is not one of the 6 factors that differentiate public companies from private companies, because regardless of whether you're public or private, you do have market volatility. That is something that needs to get factored into the equation if you're granting stock options, and certainly public and private companies go up and down based on a number of things, not the least of which is the economy. So here's the slide that we were jumping ahead to before. It's really just the final expected dates for the revenue recognition standard. And again, that the thing to highlight here is it's probably not going to be effective until 2016, but it could be retrospective back to as early as 2013. So if you're a large company with complex revenue components, you are going to want to be thinking about the information systems, the data that you're capturing, and that what this retrospective application may be to you, because you may need to go back and restate revenue for those old periods when you adopt. So you definitely want to be tracking this and understanding the rules, because I think now that the revenue rule has been commented upon twice, I think it's fairly close to how it will be in its final standard when it's issued.
All right, so today we've covered changes in derivatives and hedging, presentation of financial statements, foreign currency matters, comprehensive income, balance sheet offsetting, fair value measurement, and the FASB project update. So we've got a couple of questions here that have come in. So let's see here. Here's a question. You've covered a lot of new standards. Is there any one standard from the existing standards that we should be focusing on?
Yeah, I mean, I think, well, I'll jump ahead to maybe the one you should be focusing on the most. In my opinion, is the stuff down the road. Revenue and leases are probably the most impactful. But of the ones that we've covered today, I guess my opinion then would also be even though the polling question may have said that was not applicable, the FIN 48 stuff, the unrecognized tax benefits, presentation of those, you may not be deeply involved with that, but your tax provision preparer or your CPA doing the audit probably is, and it might make a big change to how it's presented. Although the caveat there is maybe the readers of the financial statements aren't going to be impacted by that change, but it might make a big change.
Yeah, and I guess the other thing I would say is certainly for private companies, with the formation of the Private Company Council, there now really is a voice for private companies to be heard and to simplify the accounting rules. And one of the complaints of the FASB is that every time they put out a new standard or a proposed new standard, they're not getting enough comments in, and they're basically saying, how can we do our job without the proper feedback? So if you just go to the FASB website, there's a quick link there to the Private Company Council, and it's easy to communicate with. Just shoot in an email. So if there's something that your company is experiencing and just a disclosure rule that you think is nonsense, use this as an opportunity to be heard and try and steer the Private Company Council in the direction to focus on eliminating the rules that you think just don't make sense.
Okay, we have 1 minute and probably time for this last question. The question is for you, Mike. Do you advise clients to apply new rules retrospectively when permitted but not required?
Yeah, I guess that's a tough one. Anytime there's kind of flexibility or options with the new rule amendment, it does gives you options of how to deal with it. But then the question is, should you jump ahead and apply things when it's just not required, but it's available for you to do? So applying a rule retrospectively, does mean that you're changing a prior period that's been presented if you're presenting 2 years of a balance sheet, let's say. But But I think anytime for private companies, I would say a lot of times, as you've seen today in our presentation, public companies have to adopt these rules first, and that gives a chance for private companies to see how public companies are adopting them, and then you can kind of react to that. So depending on the facts and circumstances, sometimes it's better to hold off and wait to adopt it when you have to, so you can see how others and kind of the industry norm is reacting to that rule.
Okay, great. Thank you. So up on your webinar pane, you should see the slide. If you'd like to contact Matt or Mike, please take note of their information, and they'd love to hear from you if you've got any further questions. We will be giving you the copy of the presentation and slides in the next 3 days. So thank you for tuning in today, and I hope you got some good information, and you have a great day. Thank you. Bye-bye.